Just making sure. What up, what up, what up, what up? Are we live or are we live? Are we live or are we live? I think we're live. What up, everyone? Welcome back to Financial Education and Business. So, on this channel, all I talk about is stocks and investing and analyzing and researching. Eventually, we're going to get to where we need to get to, finding some of the best stocks out there. And today, we're going to be trying to find the best small cap stock. Like, we've been doing this for a while now, and the goal is to look at some investors out there that do really good research and take some really good pointers from them, and we are going to go from there. And then we're going to use AI to look at what we should consider when we are investing in small companies, and then yeah, we'll go from there. Here's the video. Let's watch it while we do research.
Investors. I've just started researching the World Small Cap Index and looking at the first 50, which are the best stocks out there. I have found a pattern that gives us 5 to 10x stocks. At least you know what to look for. The formula is the following. You don't need crazy things. If revenues just double in 10 years, that's revenue growth of just 7.2% per year. There is then a little bit of improvement of margins, which means that it is a good business, so that net income, let's say, triples in 10 years. There are buybacks or dividends that return capital, show that the business is healthy, making cash, which then allows for dividend increases or dividend per share increase of 4x or earnings per share of 4x thanks to buybacks or dividends. That means that you have a great business in your hands, the market recognizes it, and then also what Peter Lynch says in his book, it gets an valuation expansion of, let's say, if the price earnings ratio is 10, it often goes to 20. And then on top of everything good, you also have a valuation expansion because the market now sees it as a good business, and the result is 4x in business development over 10 years, 2x in valuation, and that's an 8x, 5 to 10x, depending on the current situation in the market. And that is an investment return of 23% per year based on revenue growth of 7%. So in this video, I'll discuss the small cap index, where I'm looking for such businesses, give you about 7 examples of how I created this pattern, dig deeper into the formula and discuss where to look, what are the industries, the modes, the requirements, how those businesses expand through mergers and acquisitions, usually, which is a very good thing when done well, and also share my research process and why am I looking at all the 3,500 companies of the MSCI World Small Cap Index. If you enjoyed this video, if you get value from this, please don't let that like button remain a small cap. So let's immediately start by discussing the iShares MSCI World Small Cap Index. I have started looking at the small caps, and if you want to get to 30 billion, Warren Buffett says,
I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums and there's more chance that something is overlooked.
So I have started with the A's, the first 50 by market capitalization, not really with the A's, but the highest market capitalization in the index, and those are usually the best companies, the companies that did best over the last period, thus have the largest weight in the index. And I will look at all 3,518. Before this video I did the first 50, I already done more when this video comes out, and that's what I usually do. I will put a link into the description below. It will be on free preview on my stock market research platform, so you can check everything there. You just scroll down to the curriculum of my research, and if you go here, it will be available for everyone. You can see my notes on the first 50 of the small caps indexes. And why small caps? Well, small caps over the times that performance is measured have performed the best. This is
All right, so small growth, small neutral, small value, big growth, right? Okay. So green small value are the ones that do well. Historic relative performance. Um, let's look for that chart. So relative performance of FF size value portfolio historical trends. So I think it is kind of important to see free online portfolio blah, 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 image. It'd be good to see historical performance metrics, 6 asset allocation models, um, visual 90 year of stock and bond performance. Oh, this might be kind of cool to see. Visualize 90 years of portfolio visualization, analyze portfolio visualization analyzer, measure portfolio performance, Fama French factor image, the best and worst average investment returns. So annual returns from 1926 to 2019, worst, best. So the best, the worst here. These are -60, -40, -20. So since 1926, bonds have posted negative annual return about 15% of the time. Percent of the year within negative return. So 28% of the year in a negative, 23, 15%. So 60, 40. So percent of year with negative return. So 28% stocks, 28% of the year. 60, 40, 23 bonds, about 15% of the year. A 60-40 portfolio had its worst year in 1931 as the U.S. economic factor, banking crisis, and the money supply fell about 30% between the 30s and 33. Yeah, the Dust Bowl. Yeah, So allocation stock to bonds. So average return, 100% stocks. Average. So this is the average. So best year. On average, traditional 60-40 portfolio has returned 8.8 annually. While the higher you go with bonds, the less returns you have. The more you have in equity, the higher your return, 10%. A $100 invested in 1926 is equal with a dividend reinvested would have soared to over 877K by 2019. So it is kind of not ridiculous, but really interesting that over and over and over again, when we look at the numbers, long-term investing is the best investment style. A closer look at historical correlation. So this is bonds, this is stocks. In 2008, stocks really didn't do as well. Um, bonds did well, okay. During the 1969, stocks, bonds moved in lockstep. In 2002, you've lost, what about a little bit over 22%. So the last time stocks and bonds moved together was 1969. Current investment return, context, map inflation projection, map GDP growth, American financial portfolio account type. So employee, so September, employer retirement plan 38%, brokerage bank 14%. All right, this is kind of not helping. S&P 500. Trying to find historical small cap. Let's go historical small cap stock return. So we're trying to find how well small cap stocks do. All right, so this might be a decent chart here. So S&P mid cap, small cap, composite, and S&P 500. So here it looks like mid caps actually have performed very well historically. Small caps are second best. Purple is next. Composite 1500, and then S&P 500 is at the end here. Historical return seems like mid caps perform very well. I see. So S&P small cap 600, small cap ending value. So cumulative performance of S&P small cap 600 versus the Russell 2000 index. Cumulative index performance based at 100. So the S&P small cap 600. Yep. Russell 2000. Wow, the Russell doesn't. So the S&P does perform well, at least up to 2017. S&P 500, Russell 1000. Interesting. So small and mid cap value versus large cap stocks. So as mid cap 400 seems to perform well according to this, and then the second is the small cap do pretty well. I mean, I can't trust this. FDIC, Bank and Trust. As of today, small cap, mid cap stocks on year-to-date basis are performing better than the large cap counterpart by 3 to 2%. There is an ebb and flow, but going all the way back to 1944, small and mid cap stocks have outperformed large cap stocks by about 0.66 to a 1.5% respectively. Financial theory supports so far this year. It is also true that when you add them to your portfolio, they lower your risk due to the additional diversification. All right, bro. So it just seems like mid cap, small cap stocks do well. Now it would be interesting to see what are the types. What are the types? What are the types? The types of small cap stocks. That would be an interesting thing to find out. So small cap stocks are generally defined as companies. Let's look at a visualization. Small cap. So stock market cap. So small caps sit right here. They're above the micro caps. 300 million to $2 billion. Historical return. So this is the Russell rolling 20-year return. U.S. stock, U.S. large cap, U.S. mid cap, and U.S. small cap. So in 1991, it seems like the small caps really outperformed these years from practically, essentially from 1991 to 1999. Small caps performed very, very well. And then we see a little bit of a difference here with the U.S. mid caps. And mid caps overall perform really well, while the U.S. large cap doesn't perform much worse. But at the end of the day, it seems like annually the returns on the small caps are much better than the mid cap, large, or U.S. market. Even if you look at these red periods in 2018, 2019, right before we got into COVID, we see that the mid cap and small caps returned much higher returns. Small cap stocks, understanding the risk and return. So market capitalization, yep, potential for higher return, less popular, potentially undervalued. High growth potential. Smaller companies have more room to grow. That's true. Business diversity. So exists in all sectors, offering wider investment options. So high volatility. Yep. Low liquidity. So liquidity is important. So you can sell out if you need to. There's less information out there. Long-term historical. Long-term. A historical outperforms large cap, but with higher volatility. Recent history, large caps have outperformed small caps in the past 2 decades. I don't know when this data came out, but I don't know how much of it is true. Microcaps, so characteristics, examples, and risk and benefits. So you got the microcaps, small cap potential for growth, high return potential, but also high volatility, and very small limited return. So I mean, historically, the fact that we see that small cap US mid caps overall outperform the large caps. I mean, even in this year 98, where we see that small cap stocks and large cap all performed evenly, but there wasn't a year really that US stock market, US large caps outperformed US mid and small cap stocks. So that's good evidence there. Um, Now let's get into the types. There's so growth-oriented small caps, value-oriented small caps, niche small caps, cyclical small caps, micro and nano caps. Overview of small caps. So growth. So these companies are often younger or in earlier stage of scaling their business, with significant potential for rapid revenue earning growth. They might be in emerging sector or innovative niche. So right now it's going to be a lot of the AI data center companies, right? Um, and then we have the value-oriented small caps. These are companies with solid fundamentals and stable cash flow, but are currently undervalued relative to their competition. They often operate in a less exciting or more mature industry and can be bargain identified early. So value oriented, growth oriented. So value oriented means they're a solid company, pretty good, stable financial statements. So cyclical, so companies whose business perform heavily depending on economic cycle. I definitely say no. I definitely would say no to those kind of stocks. And then we got the micro caps. These are small, 300 to 50 million market cap. So all right, so this is what we should be looking at when investing in small caps. So look for companies with PE ratio around 10 and stable within that 10. Single digit annual revenue growth. So 7 to 8% per year. They continue to grow year over year. Achieve both organically and by selective mergers and acquisitions. For favor business able to improve margin profit as they scale, leading to net income triple in 10 years. Even if revenue only doubles, seeks gain of operational excellence and continued margin improvement. So companies that consistently generate healthy cash flow and deploy them for buyback or dividends. Companies that consistently generate healthy cash flow, yep, and deploy them for buybacks or dividends. I really don't think so. I don't think small cap stocks should be paying dividends. I think if anything, maybe do buybacks. Not even that. I prefer that small cap stocks focus on um, that focus on growing the company, whether it's research, development, or even marketing. Some people do not understand that marketing is a type of investment in the company. So it's not just an expense like any other like business expense. Marketing is one of the best investment tools that you can have. Which companies that uh, consistently generate healthy cash flow and deploy buybacks, lead to a 4x increase in earning per share or dividend per share. Which watch for valuation expansion as the market recognizes business quality. A business bought at a PE of 10 could see this expand to 20 as fundamentals provide and improve and market perception shifts, potentially doubling your return. So I think it'd be good to look at the stable growth free cash flow. So target price to free cash flow ratios between 7 to 15 for high yield. Avoid expensive names with a ratio above 30. Price to free cash flow. So these are the things we should look at. So okay, I should kind of jot those things down. So small cap considerations. 1. So stable growth free cash flow. So stable free cash flow with between between 7 to 10, 7 to 15 ratio. Price to free cash flow. Um, Avoid expensive names with ratio. So avoid anything above 30, which means they are too expensive. Niche or boring indices. So look for companies in sectors that overlooked by most investors, but consistently profitable with strong defendable competitive position. So strong moat. Resilience through cycles. So resilient through cycles. I totally agree. Like, it doesn't make sense to invest in a company that only generates good money during a certain season, like Christmas or maybe only during time of war. So you want a company that can make money throughout the year. So they maybe would have business with the government, but also they would have business with commercial. So buy during industry or business downturn where fundamentals remain intact, but valuations are compressed. So growth via smart M&A, growth smart mergers and acquisitions, small, cost-effective, well-integrated acquisitions add a momentum. These add momentum uh, without excessive without excessive risk. Sometimes it can be too expensive to do the research and development for the product. And acquisition is the best form of growth for the company. Resilience through cycles. Okay, so example success. So companies like Graco, Trex, okay, all discuss video demonstrate sectors with historical outperformance include small cap values. So we are going to look at the type of small cap stocks that we are interested in are going to be, I think we're going to look at small cap growth and value. So those are the two that we are interested in. We're not really going to look at nano caps at all. So recap stocks. So annual revenue, net income growth of almost 10 years at 3x. PE ratio entry 10x. Valuation expansion. Price free cash flow. Core qualitative traits. Boring niche. Mechanism of EPS dividend growth, buyback, small mergers and acquisition, business cycle timing, and then expected return target 5x, 10x in 10 years, 23 KIGAR. So about 10 years. So expected return 10-year KIGAR. Ten-year KIGAR 23%. Okay. So what we're gonna look at, we're gonna look through MSCI. So we might look through MSCI to find some of the best. Look through MSCI. So we're gonna look at the MSCI small cap index holdings. All right, so this is small cap index. Let's see what we got. Little distraction. All right, so let's keep going. So we're gonna look through MSCI. So let's look at the MSCI's performance. So max, this thing has returned about 20%, 32% in 5 years, 25% in 1 year. Pretty volatile in a month, but not that good of a return. And about 1%, and today is another percent return. So let's look at ETF database and get those stocks. All right, small cap ETF list. There are four pages. So average price change, average day volume, 1 day change. So this is a list of all small cap ETF trading in the US which are currently tagged by ETF database. Please note the list may not contain newly issued ETFs. How does someone get every stock from these ETFs? Um, you may want to visit our catalog. So ETF database. So ETF database has allocated each of the US listed exchanges to one of the approximately 70 best fits: equities, alternatives, leveraged, inverse, bond, fixed and commodities. So obviously we want equities, small cap, mid cap, small cap, blend, cap growth, small cap value equities. So we're interested in this here. So we're interested in growth. Insert link. Value. Small cap growth is what we're interested in. So small cap growth. So let's add a link to that. And then we're interested in small cap value. All right, so here are our growth and value stocks. Vanguard small cap, these are all the ETFs and how large they are. Total assets. So this is largest to smallest. So this one is 30 million to the smaller, they get obviously much smaller. Okay, acquire small and micro deep value stocks. Interesting. So what does this ETF hold? It holds very small, very small, deep value companies. So up about 1% today. Homepage, acquire deep value, that's their name, small cap value, trade data, historical trends. So alternative ETFs, and I want to see their holding performance. Let's look at the performance. So deep an ETF database. So they almost do as good or worse than the benchmark average. They hold mostly all American stocks, some in the UK, some in Colombia. Price value chart. I want to see their holdings. So this is all that they hold: Liberty Energy, Ironwood, Geopark, Peabody, Playtech Holdings, WW International, Teekaway, Tankers, Atcore, International Seaway, Amplify Energy. I think, so let's take a look at these companies. So we can just click on these. We'll just look at these lists real quick. So obviously this ETF is called acquires small and micro deep value ETF. So it acquires small cap, very small cap stocks. So this is what we're looking at today. Let me just highlight this. All right. So this ETF with ETF with Liberty Oil Service. So this is kind of cool. So it tells you how many ETFs that hold Liberty Oil Field. So all these ETFs. Interesting. Okay. So the following ETF maintain exposure to Liberty Oil Service. ETF holding data are updated once a day. Invesco S&P Small Cap. Acquire Small Micro Deep. Invesco S&P Small Cap. Okay. Okay, there's only one ETF that holds this, Ironwood Pharmaceuticals. I don't like pharma, so I'm not even gonna look at their ETFs with so Geopark exposure. So to see that breakdown of ETF, including table below. Okay, I see. Okay. Small cap and mid cap. All right, so we have our stock. So this is the goal. But so now let's continue our research here, and we'll go from there.
From Fama and French, the data and small cap value performs usually the best over the long term, and that's why also I think this formula gives value, and it is better to look for small cap value for good investments. Here you can see also the difference in performance, so this is significantly different, and if we can then eliminate the bad.
Welcome to the ARK Venture Fund.
To date, to get very good venture exposure, you basically had to be rich.
The ARK
And find the good, this performance can be even better. As they say, it pays to think small when it comes to investing. Plus, at the moment, small caps over the last 10 years, because of what the Fed is doing and everything, didn't perform as it was the case in the past, which means there might be still opportunities there. But I really enjoyed it because I have seen what I have to look into next to find those that will be the top 50 of the small cap index in the next 5 to 10 years. I need those, not those that are already at the top. So let's immediately start with the examples. So you can just click here, and here we are, the first 50, and one of the good business examples is already Quanta Services, and I have analyzed this already back last year, I think in April of 2020, and when I looked at this, I said, okay, it's a good business, it is in the utility electric, so it is good from that perspective of renewables. There is growth in the sector, which is always positive, but the stock didn't do much back then. However, I said that the cash flows are good, and that's also the first sign of future good investments, where the free cash flow to market capitalization is around 10. And you can see the company has increased earnings by 27% over the past years. The stock didn't go anywhere. Everything looked really great, except it is in a cycle, so these constructions is always cyclical, but they have done buybacks, so they have bought back half of the current market capitalization, and I have put it on the watch list. If we look at the stock, it did really well. This is a 3x over the longer run, 5x over 5 years, and even more longer term. But when you look at the business, it didn't do really much. There was an acquisition here, and without that acquisition they didn't really grow much, but they have almost doubled net income over the last years. They have significantly lowered the number of shares outstanding, which means that the earnings per share have more than doubled, and the cash flows are positive. And the result is this explosion here. I have also better examples. So the first thing to look is, as I said, stable cash flows, slow but steady growth, buybacks, which means that the business is profitable, strong, and creates value for shareholders, buybacks or dividends that really allow you to or reinvest or get higher earnings per share that give then a great stock price result. Next company that did really well over the last years, Trex company. This is almost 100-bagger over 10 years. And this company does wooden alternative decking products. So now it is really expensive, but you can see there wasn't a staggering improvement. The business model was profitable, free cash flow is profitable, and now as the sector is crazy, they have really exploded. But here the growth was a double over 6-7 years, and you can see here how from 6 it went to 48 before the current craze about wood decking products that we are in now. So this is currently peak cycle and very expensive, but I'm focused on these things. So slow and steady, a 10-bagger here on positive free cash flows, and of course you can see here buybacks. Another good example is Graco. So American manufacturer of fluid handling systems and products based in Minneapolis. If we look at the numbers, so the revenue just doubled a little bit more over the last 10 years, net income tripled, the number of shares a little bit down, and cash flows just tripled. What did the stock do over the last 10 years? It is a 5x, a little bit more. That is not bad. And you can see here, focused on the growth, so a little bit of inflation, a little bit of strategic initiatives, and then a little bit of acquisitions plus organic growth. And here they get their mix that sometimes it works, sometimes it doesn't, but gives you the 7% growth through a cycle, and that is all you need for a good investment.
This is 6 things you're looking for when you buy a piece of real estate. Number 1, cash flow. Dude, if it don't cash flow positive, I never buy it. Listen to me, I never buy it. Number 2 is you want appreciation. Just because it cash flows doesn't mean.
And you can see here how they make, and most of these businesses make these small constant acquisitions that they then consolidate into their business. So if you have a large customer base, you buy a small producer or something, and then you sell their product to a larger customer base, a little bit higher margins, better production, better margins, scale, and then they do this in these niche businesses where if you are a graduate at Stanford, Harvard, you say, I want to go to work for Facebook, nobody wants to work in fluid pistols or something like that. And therefore, as also Peter Lynch says, it is those niche businesses that nobody wants to go. But there is the money, and slow and steady long term, you can focus on the earnings and make money. Another company that did really well over the last years is Carlisle, and you can see the stock price doing really well, slow and steady over time, a little bit down in the cycle, so time to buy in the negative part of the cycle, but slow and steady compounding growth over time. But if you look at their businesses, no magic there. 1.5 increase in revenue, a double in net income, okay, 25% less in shares, that allows for a triple in the dividend over 10 years, good triple in free cash flows, and over 10 years, this is much more than a triple. This is a 6x, a really good 6x, and there is also a small dividend yield. Another business that will never see a recession, of course, are funeral services. So a lot of small businesses, and then when a bigger business comes and starts consolidating, it allows for growth, scales, profits, And that is also what works in the business. And you can see I wrote here stock 10x, revenue not even 2x, net income 4x, dividend 4x, buybacks, growing dividends, but price to free cash flow was 10% in 2010. And that is also key, the price you are paying. Now, the top 50 of the small cap index have a price to free cash flow of 30, so a free cash flow yield of 3%. And there is a huge difference if it is 10%, 7, 10%, 15, rather than 3%. If you can wait for these good businesses at a 10% free cash flow yield, then it's very, very likely you'll get a great return. Toro here, another great example of really big expansion. The PE ratio now is 25, but if you look at the revenue, it just doubled over the last 10 years. Dividends quintupled because they did some buybacks, allowed for higher cash flows, and that is the story. You don't need stellar dividend growth. And that's also what they do, invest in growth, and they buy turf links, so landmowners, robotics, whatever they can sell within their network, and they focus on operating and growth needs, but also returns on shareholders. Another example, Middleby, so this is a 100-bagger example over a little bit more than 10 years. This is almost 20 years, but you can see here a little bit faster growth, so this is 4x in growth, net income also 4x, shares stable, and cash flows also 4x. So 4x in 10 years, and the stock is almost a 10x in 10 years. What they do is kitchen appliances, and they are consolidating into that market, buying all these other brands and then scaling those brands and offering more selection to their customers so that you know where to go if you have to buy something like this. And if you look at the acquisitions, look at the number of smaller acquisitions and brands they do over a few years. So they constantly add and expand with their network, and this works really well for them. And one that isn't that expensive that might be very interesting to come back to is Berry, and you can see here how they really grew. Net income, revenue also is growing faster, but free cash flows here are around 900 million. If I compare that to the market cap, here we have a price to free cash flow of 10, which means a free cash flow yield of 10%. And if the company continues with just a 2x of revenue, improvement in net income, buybacks, you can see a 5x. This is the example of, okay, this is what I'm looking for, and I have put it on hold. When I do first 500, I'll go deeper into the top 5 that offer such potential, and Berry is the first one that does. And the company does, again, a simple niche, boring industry that you don't want to go as a graduate genius. So they do this plastics, food and beverage specialties, distribution. They have seen growth in cash flow from operations, so they are in a good place, and they are using the cash flows for capital spending and investing, half of that for maintenance, looking to reduce costs, to improve margins, as I said, and also for growth, both mergers and acquisitions. So acquisitions, divestitures, growth and scale, focused. 400 million buybacks on the 9 billion market cap is already significant, plus dividends, and if they can keep their market share, they should do good.
Over 2,000 lessons, over 100 videos for free? Yes, all the content on boot.com.
The formula, so no hype business, niche industry, a little bit boring that everyone invested in electric vehicles and all those hype things would say, this is boring, probably never had sex in their life, but profitable from the start, which really lowers the risk of getting sexual diseases. And if you can find them at the price to free cash flow of 7 to 15, then you are looking at really, really interesting things. And then if you see also the cycle, where they are in the cycle, buy at the low cycle, you're looking at a good return. Growth is key, both organic, both cost price increases and cost reductions for improving margins. Small acquisitions, not expensive, crazy, small acquisitions, smart capital allocation. So if there are no opportunities, let's do buybacks if those are cheap, and if not, do dividends. And the key is that the market doesn't really care for the stock until it already happens. So the market will see, oh, this is now a good business, look at the growth, look at the free cash flows, and then the stock price will go up. If you can find it at a cycle, a business cycle, a sector cycle that says now it's not so good, it doesn't look as good, but it has all the fundamentals to do good, then you're likely looking at a 5 to 10x investment. And that is exactly what I'm looking for. And what happens to the stock? Well, if you start with a price-earnings ratio of 10, and the market sees that it is a great business, well, when 2x revenues, 3x net income, 4x dividend, then the valuation also 2x, and you have an 8x in your hands on a niche boring business, which is 23% per year over a decade. Not a bad thing. And that's exactly what I'm doing. That's why I'm looking at the whole 3,500. Focus on those niche businesses, long runway ahead, smart management, doing buybacks, doing mergers and acquisitions, really growing that business in a niche that is not that interested to others. Thanks for watching. Smash that like button.
All right, so we're looking for companies that are, growing up 28% in 10-year CAGR, smart acquisitions, doing really smart acquisitions and or buying back their stock or paying out dividends. So portfolio price is key. Price to cash flow should be anywhere between 7 to 15% annually. Formula 5x to 10x small cap opportunities. So that's what we have to look at, is that they are growing, making smart acquisitions, and also something I didn't cover is smart management team. So next we have how I research stock, step-by-step fundamental analysis.
This video is sponsored by Morning Brew. Visit the link in the description below to sign up for their daily newsletter today. Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin. Today's video is a bit of a peek behind the curtain to show you how the bagels are made and discuss my own investment research process as a investment analyst. I've had this requested quite a few times over the years, given that I work as a portfolio manager / investment analyst for my day job, and I figured, what the heck, I would cover things at a high level, go through my general step-by-step process, and it's not a very formal one. I do change things up every now and then, but hopefully people who want to go through this process themselves find a bit of value in it. Now, a few notes before we get started. Firstly, this isn't a recommendation that people should necessarily stock pick or do their own stock research. I think most people are better served putting their efforts elsewhere, either hiring a professional or just investing passively. Countless studies have shown just how difficult it is to beat the market with stock picking. So unless you're passionate about researching stocks, you'll probably find this all very boring and strenuous, with no guarantee of strong performance. And secondly, while this is obviously my own research process, there are different ways to research a stock. There's technical analysis, which focuses on past prices. There's quantitative analysis, which focuses on analyzing the relationship between different quantitative variables. And then there's fundamental analysis, which is my own approach of understanding the underlying business. And within fundamental analysis, there are different styles as well. I do generally tilt towards value investing, which is trying to buy a great company at a great price. But there is also growth investing, which I do hold some growth companies where you pay up a little bit more, but they have a larger potential to grow their profits into the future. This video will be divided into chapters so you can skip between the different sections. I'll try to provide alternative tools to the paid ones I use at work. And I'll also throw up a few terms and whatever on screen so that you can have something to reference later on. And for the purpose of saving time, I won't try to define every individual metric that comes up. and will generally, like mentioned, keep things high level. So with that out of the way, let's jump into it. The first step, as you'd imagine, is screening for ideas and finding the stock that you want to research. The whole research process takes quite a long time. It has taken weeks at times, but obviously you'll want to narrow down your list of potential stocks so you don't waste your time doing this whole process, only to find that you don't really care for the company. Now, screening isn't necessarily a formal process. I do sometimes just research a stock because I want to, or there's been an interesting recent development, but I do have a screener that I regularly refer to. A screener lets you filter the universe of stocks so that you only have a list of companies that meet certain criteria. I generally keep it pretty broad, but we'll look for things like revenue growth, being profitable, as well as keeping debt within a certain range. From there, I'll typically put the tickers through an internal tool that summarizes all their key financial information onto a one-page summary, not to make any decision off of, but again, just to get a quick overview of how healthy or unhealthy the company is and whether it's something I want to look into, covering things like past financial performance, expected consensus estimates moving forward, their debt levels, a bunch of details, just again summarized on a page to see if there's anything of interest here. Now, once I have the company that I do decide I want to do this deep dive into, the second step is understanding the business. Makes sense. I know that sounds obvious, but as an investor, you really are a part business owner. So I do try to take the mindset of understanding the ins and outs of the company in the same way I might if I were to buy a private practice. And that means understanding all the company's segments and what they do, how they earn their money, the nature of the company's revenues and whether they're contractual, recurring, or seasonal, where the company operates in terms of geography, customers, suppliers, employees, regulators, management, anyone that plays a role in how this company will perform. And depending on which sector the company operates within, also make note of their key performance indicators or KPIs, which again are kind of sector specific, allow you to compare companies that are within the same sector, but also requires a bit of industry background information. And there are times where I don't research a company because I don't yet have that familiarity with the industry it operates within. You do have to operate, as mentioned many times by others, within your circle of competence where you feel comfortable. Now, this part is mostly qualitative. There will be, say, quantitative figures that come up, but a lot of it is, again, just understanding the details of the operations, what this company does. So where does someone find all this information? Well, outside of a Google search, which is not a bad idea to give you an overview of the company, a good idea is to start with the annual report, or 10K in the US, as well as the most recent quarterly report, if that doesn't also apply to the 10K, all of which you can find on Edgar in the US, Cedar here in Canada, or the company's investor relations page, because they do a good overview of the company's business, the risks applicable, and key financial information. From there, I like to go through investor reports and recent 8K filings, which provide important updates about the business. And I do have access to a lot of paid for research, which I'll typically go through the external analysts' reports on this company. I also might look up commercials, tutorials, customer reviews, find any information I can about them. Now, as you'd expect, that's a lot of details, so I do type notes as I'm going. I do typically categorize stuff under the SWOT framework, which is strengths, weaknesses, opportunities, and threats. Strengths and weaknesses are internal factors for the company. Opportunities and threats are external factors. And that just lets me quickly categorize stuff. I'll also write questions that I want to get to later if there's something I don't understand or a risk that I've thought of that I want to look into. I kind of do a parking lot of ideas that I want to go back and research at a later point. And my goal through all this is trying to find quality companies that have a competitive advantage, an attractive business model, and as Warren Buffett likes to put it, a moat, something that sort of protects them from competition. All right, so once we understand the business, the next step is understanding the finances, where we get into the numbers. Obviously, this is very number heavy and does require an accounting background to understand the different segments that you look at. But generally, I'm looking at the company's financial position in terms of debt, how solvent they are, their capital structure, and whether they can meet their payments, the company's growth profile.
We have got to the point where literally anybody can build a fully working app without knowing how to code. This is
their profitability, and again, where they have areas for improvement. A lot of this, as you would imagine, does really boil down to analyzing the financial statements, the income statement, which tells you how the company performed in the given year in terms of accounting earnings, the balance sheet, which gives you the snapshot of what the company owns and what they owe, as well as the cash flow statement, which is similar to the income statement, but shows you where cash is actually moving within the business, not just accounting earnings and accounting costs, where money was actually spent and earned. Now, I typically start by calculating a bunch of cumulative average growth rates, which I'll throw out the formula for, but I'll do this formula over a 5, 10, or 15-year period to get an idea of what the average growth rate over these periods are for revenues and profit measures. I also really like common size financial statements where you put everything as a percentage of a key figure. So for the income statement, that's revenue. For the balance sheet, that's total assets. And this is a great way to look from year to year to see what costs are getting bigger, which ones are getting smaller relative to the amount of total money that the company is earning. Then I'll calculate a bunch of margins and ratios that, again, give that profile about how the company is growing, how profitable they are, and different operational solvency, liquidity things that tell me the general state of affairs. It's also here where I'll carry out a sort of peer analysis, comparing this company to ones in a similar space based primarily off of these financial details, as well as the key performance indicators found earlier. And I have at times pivoted to a new idea based on this peer comparison because something else looked more attractive once I really got down to the numbers. Now, throughout this whole process and earlier with the overview of the business, I do carry out a check for red flags. Call it forensic analysis. In understanding the business, I want to know what the related party transactions are, how management is compensated, any conflicts of interest, and in terms of finances, any accounting shenanigans. Unfortunately, you can't always rely on the figures as they're reported. Companies do at times fudge the numbers. For example, it's really common for management to highlight what's called an adjusted figure, which is where they take an accounting figure but then make some changes to it so that it's more representative of what they believe the company has done. And it's not to say that that's always nefarious, but it's really important to look into what the definition of that adjusted figure is and what they are adding or taking out of this number, because the reason it's adjusted is that it doesn't meet accounting rules or regulations. Now, in terms of where to find all this information, I primarily rely on a data terminal that my company pays for, which unfortunately just isn't an option for a lot of people. They are very expensive. There are free versions out there with not quite as many features, but they're a good starting point for getting, again, the financial statements easily accessible. And if you can get something with an Excel add-in, kudos, because that really makes it easier to pull the data that you're looking for into the template you want when it comes to things like peer analysis or just the specific metrics that you want to look into. I've made a crazy amount of use out of Excel templates and programs that pull data terminal information. And one of our sort of proprietary things, for example, is a peer comparison scorecard, where based on the industry, there are different metrics that are populated to compare companies at a very high level and quickly see how they look on different KPIs, finances, all that stuff. So I'll include some free alternatives. I can't really vouch for many of them, but I have heard of them. And if you're relying on a service for data, make sure you understand how the data is pulled, whether it's aggregated, whether they make any adjustments to it, because it makes it really important when trying to research a company is being able to rely on the data. All right. Step 4. It's taking longer than I expected, but step 4 is understanding the strategy. Everything we've done so far is a sort of historical perspective on things. At this point, I want to know what the opportunity moving forward is. This includes going over the strategic priorities of management, as well as where they plan to spend money, what the capital expenditures moving forward will be. Capital expenditures, I don't think I've talked about, but found in the cash flow statement, and it covers the money the company is investing in itself. I also want to know how they'll be financing those plans. So I'll consider whether they're taking on more debt or issuing shares or hybrid instruments, which get a little complicated. Regardless of what the plan is, what I'm looking for is to evaluate its feasibility, the risks involved, and the company's track record for doing what they say they will do moving forward. I've seen a lot of companies fail by doing something that they have no experience in doing. So it helps when a company, if they are a serial acquirer, where they buy a bunch of businesses, it helps when they have a history of doing that successfully and growing their company as a result, actually optimizing the companies that they bring in under their umbrella, rather than just spending investor money to put growth on the accounting statements when they aren't actually improving their business. One way you can evaluate the track record is by looking at the 5, 10, 15-year average or some variation thereof of ROI figures, which includes return on capital employed, return on invested capital, and return on equity, among others, but those are ones that I look at. And you can do a qualitative review of management as well in terms of their experience or tenure with the business. One of the things I found really helpful myself as an analyst, as a quick tip, is building out a checklist of things you want to explicitly look for. And this is a checklist that you build out as you research companies and you think of things that you want to look for when trying to determine what the moat is, whether they're a healthy business, all this stuff. I have my own checklist that I built over time. Just an example of one thing on there is whether the company adds value for all of the stakeholders, or are there any stakeholders outside of competition that will lose from operations and that will present a risk to.
In the Win with Zinn sweepstakes, you can get a chance to win $100,000. But there's more than one way to win with Zinn. Here's how
the business's success. In terms of where you can find information about the strategy for the firm.
All right, I kind of want to read this. So obviously Warren Buffett finally finished up and he dropped his letter. There's a few final thoughts. So one perhaps self-serving observation. I'm happy to say that I feel better about the second half of my life than the first. My advice, don't beat yourself up over past mistakes. Learn at least a little from them and move on. It is never too late to improve. Get the right heroes and copy them. You can start with Tom Murphy. He was the best. Remember, Alfred Nobel, later of Nobel Prize fame, who reportedly read his own obituary, was mistakenly printed when his brother died and a newspaper got mixed up. He was horrified when he read and realized he should change his behavior. Don't count on a newsroom mix-up. Decide what you would like your obituary to say and live the life to deserve it. Wow, that is deep. Greatness does not come about through accumulating great amount of money, great amounts of publicly or great power. Great amounts of publicity or great power in government. When you help someone in any of thousands of ways, you help the world. Kindness is closeness, but also priceless. Whether you are religious or not, it's hard to beat the golden rule as a guide to behave. I write this as a one who has been through thoughtless countless time and made many mistakes, but also became very lucky in learning from some wonderful friends how to behave better. Still a long ways from perfect, however. Keep in mind that the cleaning lady is as much human being as the chairman. Dang, bro. Warren Buffett. Now that is a lesson for a lifetime. I'm actually going to tag this in my pin this at a post, pin to your profile, pin. Yeah, I'm going to pin this. I think it's pretty good wisdom. Alright, let's continue this video.
You can typically find it in those regulatory filings. The 10K will typically have some sort of high-level strategic objective for the business. But you can also look at investor presentations, which again will highlight it. And transcripts from earnings calls are great because management is often asked questions about what they expect to do moving forward and the challenges they expect. You might also find transcripts from the different conferences management have gone to, which you again might be able to find on the investor relations page. And also through my company, I've been able to meet executives and have calls and attend in-person meetings with executives from different companies. In terms of researching the industry, again, I do have some paid for services which really help. I do really rely on the data terminal as well as some expert inputs and news sources. But in terms of news, that's actually a good thing that most people can access is just researching news about the industry. You might be able to find some different research stats about total addressable market and whether things are growing or contracting. So once I understand the business, I understand their finances, and I understand their strategy, from there, I'll look at the actual valuation for the stock. It's something I leave later on into the process because I don't want my earlier steps to be influenced by whether this stock is expensive or cheap, even though that is important. There are a number of methods for doing this. At a high level, there's relative valuation, which is looking at multiples, things like the price to earnings multiple, EV to EBITDA, free cash flow yield, things like that, which you can compare historically to what it's been in the past, as well as to peers to see what related companies or companies in the same industry are trading at, to see whether you're above, more expensive, or below that level. The more detailed approach is an absolute valuation, such as a discounted cash flow, which I do from time to time for companies, where you actually forecast all the line items of different financial statements to forecast their free cash flow into the future, discount it to today's price, so that you have an idea of what you should pay today for that future performance. I like to change the variables to see how the company's stock price would be in different circumstances and what's justified in terms of the stock's price. I'll also consider the more current events around the stock, recent lawsuits, current headlines, press releases, which you can again find on the company's website. And I'll try to understand what variables in this realm are influencing the current stock price, as it tends to be the more recent stuff that sways prices in the short term. It doesn't matter much as a long-term investor, but it does help with the entry point. And I do consider some technical aspects of the stock, and more qualitatively, things like whether management is buying or not. But really, at this point, if I like the company and I think the valuation is attractive relative to what it could potentially earn, then I'll likely be investing at this step. Now, the problem is that stocks that have gone through all the previous sort of filters and steps at this point tend to be the most expensive. The stocks that have great growth track records, great profitability, excellent management, all that perfect stuff, they tend to be more expensive because investors recognize that and they bid up the stock price accordingly. But if the company is not attractively valued, it isn't all for naught. At this point, I will simply move it to a watch list, at which point I will monitor it. I've already done the fundamental research and will have more flexibility to hop into the stock if there's a dip in the price given a current event. I can quickly analyze the current event, see if it's material or not, and then take advantage of any.
So if you want to trade profitably, the best place to start is probably just go to this free community. Yeah.
Movements in the stock price. I will also dollar cost average into companies I really like, and generally speaking, that's a sound strategy for diversified investors, but I always have an eye on valuation. Paying too much for a stock does increase your risk of capital impairment, so I at least want to ensure that the price I'm paying is within a reasonable range. So that's a valuation step. And finally, step 6, we've made it this far, is to review and finalize notes for future reference. At this point, I'll have an idea of whether I want to buy this stock now or wait. But I will also seek answers to fill in the gaps, address those questions that came up throughout the research process. I'll also try to play devil's advocate and find conflicting reports about, say, the thesis I've sort of developed with this company, find opposing opinions to try and sanity check some of my assumptions. I also have the benefit of being able to then share it with my team who have more experience with researching stocks than myself. And I typically write up a formal report, but will still organize my notes regardless. Just so that they're easier to digest in the future, making sure things are bullet points, providing a sort of summary that I can quickly reference in the future so I can get up to speed about my company and the thesis I have for it, and also points I want to follow up on. And the reason why I think this step is really important is not only because when a stock's on your watch list, you can quickly review things and get back up to speed about the company, but when times get tough and, say something negative develops about the business, that a lot of people are spooked is going to challenge their future performance, you go back and see what the fundamental business is and what you believe the value lies in, what your thesis about the company is. And that will make it easier to evaluate whether that has fundamentally changed or if this new development is just noise that you can generally ignore and focus again on the long-term prospects of the business you've invested in. So that's my investment research process as an analyst. We made it. Thank you for sticking to the end. I know I didn't really get into all the nitty-gritty about the specific things I look at, but that is really out of respect for my employer. They were gracious enough to let me do this video. They don't have the perfect Krabby Patty secret formula, but they do have proprietary stuff that it's in their interest to keep. As I've hopefully highlighted, this is an ongoing process.
All right. Hello, everybody. Welcome back to another episode of Tech Bros. We are live. We got a lot to talk about. We just had Robinhood earnings.
We have a major flip going on in the market. We're not talking flipping flapjacks here today in this video, folks. Welcome into the reaction channel. So public count up $97,000 here today. Obviously a very big day for the public count, but I wanted to speak at the beginning of this video. Why does your portfolio stair step up and why does it elevator down? We'll speak about that and how a portfolio is constructed and those sorts of things at the top of this video. Then I want to talk about a few stocks that are, let's call it, actually struggling a little bit in regards to their stock prices. One is Meta. So Meta stock today is the same price it was back December of last year. Okay, so I want to speak about Meta, what's going on there in this video. I want to talk about Cake. What's the deal with Cake? We're only up about $17,000 on the stock now at this point in time. Cake's just been kind of bleeding. You know, even on a great green day today, down 2.5%. So what's going on with Cake? We'll speak about that. Nike, when is this stock ever going to go up? Like, it's just been dead money and it just, you know, never goes up. We'll speak about Nike in this video when it starts to move, okay? Then I want to talk about Palantir, SoFi, Celsius, merge. Those stocks skyrocketed today. Like, you see the market up 2% or so, right? Celsius up 7%, SoFi up 8%, ELF up 8%, Palantir up 8%. Like, why are those stocks so insane? Like, why are the moves so dramatic in those stocks, okay? Then I want to speak about Duolingo. Duolingo, A+ income statement. Very impressive out of them. Talk about if that's an opportunity or not. Robinhood, A+ income statement out of them. Very, very impressive. We'll talk about if that stock is an opportunity or not. From there, I'm looking forward to reacting to Tom Lee, everybody's favorite bull in this one here today. Tom Lee went on CBC a few hours ago, spoke about his views on the market. I want to share my opinions and perspectives based on that. Ed Yardeni went on as well, spoke about his views on this market, and Stephanie Link as well. So looking really forward to reacting to all those videos here today. I appreciate y'all for joining me. One thing and one thing only I need from you, if you could please just hit that thumbs up button. You could just hit that little thumbs up button. You would mean the world to me. And for every single person that's already done it and you didn't need me to ask, thank you to you guys. You are the real heroes out there, okay? Additionally, if you want to be subscribed to this channel, you can certainly subscribe. We're now at, I think, 120,000 subscribers or somewhere around there, ballpark. I appreciate everybody for being subscribed here, okay? Listen, here we go. December 14th. That will be the day I am closing my private stock group to new members. It has been overwhelming demand this year and insane members. Demand has been, you really need to talking to them up at some Q1 2026, maybe be able to take a private stock group before we close that baby up to new members, okay? Alrighty, so stair step up, elevator down in regards to your portfolio. Why does it happen, right? What do I even mean by that? Some people are like, what does that mean? Stair step up basically means when your portfolio is going up, it's not going up nearly as quickly as when the market went down. And that's what we call elevator down, right? If you take the stairs down, it's a very slow process. Imagine you're in a 30-story building and you're walking down the stairs. It's going to take you a long time to get to the bottom, right? An elevator, on the other hand, you go straight down. Now, you look at the public count here today, up 97,000. Good day, if not, I mean, a great day for the portfolio. But at the end of the day, like, it goes down faster when the market gets really shaky. And why does that happen? Well, a lot has to do with a couple things, okay? One is the algorithms, right? These algos are so sensitive, and when those algos start getting set off, what you can start to have hit is stop losses. And when those stop losses start to hit, it creates even more selling pressure. When that even more selling pressure gets hit, the algos say, let's sell as well, right? And remember, a lot of the trading is done by algos nowadays. So that's one part, okay? The second part, and this comes down to humans, not machines, okay? Humans, what happens? Fear is a emotion in humans that's much more, let's call it, much more powerful than not fear, right? If I told you, dude, your house is on fire right now, you're gonna freak out. What? My house is on fire? What? If I tell you, dude, your house is not on fire right now, you'd be like, yeah, okay, what's the big deal? Good, that shouldn't be on fire, right? And so that emotion in us humans, right, when we hear something's bad or something's going on, you're like, we got to get ready. Like, we got to do something here. We got to sell, right? And that selling breeds more selling, more fear, more people talking negative all simultaneously. And that's why you can get the market to go down substantially sometimes. I mean, sometimes you can get the stock market to go down, I mean, 20, 30% in regards to NASDAQ, and it can happen in a matter of months. It doesn't need to happen in a matter of years. It can happen in a matter of months. But that fear also comes in. Everybody starts talking negative. Everybody starts getting fearful, right? Boom. And then you add on margin on top. We know there's a lot of money out there on margin. You add all three of those elements, and that creates... Now, meanwhile, on the buying side, right? Buying is much more predictable. People and funds usually come in with their weekly or monthly buys, and people would be willing to sell $1 million of stocks in a day. Most people aren't willing to buy $1 million of stocks in a day, right? Like, most people don't say, they don't just wake up one day and they say, I'm going to throw my whole net worth in the stock market. I'm going to throw my whole net worth right now in Meta stock and Tesla and whatever stock, Palantir, blah, blah, blah. But they do wake up and say, I'm scared, I'll sell my whole portfolio today. That happens all the time. Every single bear market that happens. People say, I'm done, I'm selling everything today. So people will invest gradually over a period of time. People will sell their whole flip and flapjack and portfolio in a day. And that creates major, major downside. And it's not just retail individuals. We're talking big money does that as well. Like, a lot of hedge funds will just mass liquidate positions. Boom, boom, boom. Some of it comes down to also margin calls and liquidity problems and things like that, right? So that's why this situation occurs where, NASDAQ goes down 3%. And NASDAQ goes up 3%, and maybe you got hit harder on the way down than you did on the way up. And you're like, how does that work like that, right? Happens all the time. Metastock, next up here. Metastock is being a lagger. Like, this stock didn't even keep up with the NASDAQ today, up 1.6%, right? So Metastock has suddenly turned into a lagger, a dud of big tech, right? When it was one of the best performers, like, the stock was a beast. So what is going on here with Meta, okay? Here's what's going on with Meta. People are very fearful of the spend. Zuckerberg's going crazy with the spend again, and investors are getting scared. And for good reason. Remember, the last time Zuckerberg went crazy with the spend was back in, end of 2021 into 2022, and we saw what happened with Metastock. Metastock went from a $300-something stock to $88. So naturally, people are going to get very scared when all of a sudden Zuckerberg goes too aggressive with the spend. So they're already pushing back big on this and like, Zuck, chill, dude. You're spending out of control, right? And so Zuckerberg is going to have to keep those expenses in 26 somewhat in line with revenue. Like, let's say revenue goes up 25% in 2026, okay? Expenses need to go up 25% or less, basically. They can't outweigh. If expenses in 2026 are up 40% and revenue is up 25%, it's going to be hard to get Metastock up. It's going to be very, very difficult because people are not going to like that. They're going to push back, and by pushing back, they sell the stock, or they just refuse to buy it, right? Now, with that being said, here are my numbers in regards to Meta. Keep in mind, revenue in the latest quarter, they grew revenue 26%. So even under my bull case, I have a serious step down in revenue growth rates. I have them only doing 20% a year revenue growth, and then 22% net income growth per year, okay? If they have a 20% top line, 22% bottom line, 35 to 45 PE would be fair for the stock. So we're talking about a compound annual growth rate in the 30s, okay? My base case, this is what I'm expecting from Meta. I'm expecting 15% revenue growth per year. Keep in mind, ladies and gentlemen, that's a mile and a half away. We're talking 1,100 basis points away from where that company's been growing. They've been growing revenue 26% in the latest quarter. I have them going all the way down to 15% on average per year. 18% net income growth on average, okay? 29 to 34 PE. We're talking about, I get a CAGR in the stock in the 20s. Meta's a buy today. It's an easy money buy, right? Even my bear case has them doing only revenue growth at 10%. The company's growing revenue 26%. So to go down to 10% would be a disaster. And then no lift in the net income. So 10% net income growth, 23 to 28 PE. I still get a CAGR that's probably going to beat the S&P 500 over the next 4 years. So my bear case, I still beat the S&P 500 likely. My base case is amazing, 20% plus CAGR in the stock. And then the bull case, if that plays out, we're talking about a 30% plus CAGR. We knocked it out of the ballpark. So the bottom line is Metastock is a buy right now, today, right now, ladies and gentlemen, okay? Now, in regards to Cheesecake Factory, what's the deal with cake? Oh, okay. I'll show you what the deal is with cake, okay? Like, cake, it's almost my birthday, by the way. Did you guys know that? Okay, where do I want to start with cake? Okay, so let me just pull up. We'll pull up the cake. We'll pull up the gava. We'll pull up the sweet green, which is what, SG. We'll pull up the Chipotle. You guys remember Chipotle? Okay. We'll pull up the Buc-ee's, S-Bucks. And you'll get to see just, this industry is just bad this year, man. Bad. So this is a year to date for these stocks. Sweet Green year to date is down 83%. 83%. Cava's down Cava is down 56% this year. Chipotle has basically been cut in half this year, down about 50%. Starbucks is down 8% this year, and Cake's down 5%. No one wants to own anything in the restaurant, food space this year. It's just the way it is. Let's pull up Darden. Let's see if Darden has beat Cheesecake this year in terms of performance. DRI. Darden's a big restaurant player, owns Olive Garden, a bunch of other big brands, Yard House, blah, blah, blah. And Darden has underperformed Cake this year. Darden Restaurants is down about 7%. Let's pull up, in my opinion, arguably the most well-run restaurant chain in all of America, Texas Roadhouse. They might even beat Cake, and that's a hard thing to do. And Texas Roadhouse down, 10.7% this year. So the bottom line is, folks, this industry just sucks in 2025. It is what it is. Some years you're going to, have some stocks in industry, and there's just no momentum. So Cake has such an amazing next 5 to 10 years ahead, right? With the Flower Child expansion, with the North Italia expansion, they got an ATM business model in the Cheesecake Factory, and they got a bunch of concepts they're growing. But with that being said, and it trades at like a 12 forward P or something just silly. But at the end of the day, no one wants to own these stocks in the space. And if no one wants to own it, what are you going to do? Like, you know what I mean? Like, if it's just, the good thing for the Cake, and this proves how great the Cake's business model is Cake is outperforming these other companies. It's done the least bad of Darden, Starbucks, Texas Roadhouse, Chipotle, Cava, and Sweetgreen, which means it's seen as defensive also. If you're going to think about like who's defensive in the space, it's actually Cake. So Cake has that amazing offense the next 5-10 years with all the locations they're going to be able to expand into for Flower Child, North Italia, and other concepts. But they also are giving you great defense. Like you could have been in Cake down 5% this year. You could have been in Sweetgreen down 83%. Like Sweetgreen might never get back to the price it was at the beginning of this year. And if it does, it's going to take years to get back there. You could be in Chipotle stock down 50% this year versus Cake down 5%, right? So the bottom line is Cake's set up amazing for the long term. It's just no one wants to own those stocks right now. Nike, when does this stock go up? Listen, it is clear as day Nike's business model has turned. The numbers are proof of that, right? But with that being said, if you're thinking about a stock that's remember, Nike's a big market cap, right? If you're thinking about a company that, who do you want to tax loss harvest with, right? Nike's coming to mind. Like Nike's coming to mind because a lot of people are thinking like Nike stock's not going to move up in any substantial way between now and year end. And they're like, I'm sitting on a bunch of gains. And so why not go ahead and sell off Nike? So even though that company has turned the corner with their business model, everything's headed in the right direction, the stock isn't, because that's facing tax loss harvesting at the end of this year. And so it is what it is, man. It is, it is what it is. It doesn't matter what their numbers are right now. Like people just are kind of look at that and they're like, wait, I'm down a bunch on this. I sold a bunch of profits in these other stocks. Sell Nike. We'll buy it back in the first quarter next year. So that's what's going on with the stock like Nike. Palantir, Elf, SoFi, Celsius. Why these stocks go so insane? Like why they got to be so drama? You know what I mean? Like why? Like why? Like it's just insane, the moves in these stocks, right? Remember, who's in a lot of these type of stocks? You're going to have people like myself that are long-term investors that love growth stocks, right? And if you know what I preach what? GVD. Growth stocks, value stocks, dividend stocks. The three, right? GVD. When it comes to those stocks, they not only attract people like myself that are looking to be in those stocks for years, they also attract, you know who else? A lot of traders that are in and out of these stocks. Traders can be risk on one day and the next day they wake up and they're risk off, okay? They're in, they're out, they're all over the place. And so if all of a sudden you get a big risk on day, suddenly all these traders are jumping right in, stock goes up 8%. And if all of a sudden tomorrow everybody wants to go risk off, stock will go down 8%, 9%, 10%, 12%. Like who knows? Remember that a lot of times the moves on the downside are even much more extreme. And so that's what's going on with those stocks. And remember also a lot of people that buy those stocks will do it on margin as well because they already have a bigger risk tolerance being in those sorts of stocks. So they'll play them with margin as well. And then also markets get shaky and either they get margin called, so they have to get out, or they just don't feel comfortable being in those stocks. And that's what ends up happening, ladies and gentlemen. So yeah, that's why those stocks are so drama. It's ridiculous, okay? Next up here, Duolingo, Robinhood, these two stocks. So Duolingo, A+ income statement here, beast numbers out of this company. Look at their net income. I mean, of course, their net income was helped by this one-off here, so do keep that in mind. But if you look at their income before income taxes, it almost doubled year over year. Went from 25 mil to 46 mil. Very impressive. If you look at their gross profit, it went to $196 million from $140 million. Like A+ income statement from Duolingo, phenomenal. What's the issue with Duolingo? Well, the issue with Duolingo is there's a lot of fear about Duolingo being somewhat of a fad product, right? It's blown up to be super popular over the last few years, but there's fear that it could be a fad product like GoPro was back in the day, like Fitbit was, and countless other things, and Beanie Babies and all those things, right? And they come and they go. And just like a lot of video games have been over time, right? Like a lot of mobile games like Clash of Clans was so popular. It's not nearly as popular nowadays, right? And it seemed like everybody was playing Clash of Clans back then. And now it's not really like that, right? Candy Crush, Soda, Candy Crush, Soda Saga, all those games were so massive, right? And then they weren't anymore. And so you look at something like Duolingo, and we see that maybe that's going to be a similar situation where, yeah, it's been insane and it's so cool and people want to do it, but ultimately at the end of the day, they're not going to want to do it, right? And so that's just something to keep in mind there. The good thing I think for Duolingo that's better than any business model in the past is really around the subscription service, right? If you think about Candy Crush, if you think about Clash of Clans, GoPro, Fitbit, they were relying on a lot of one-time purchases. Duolingo is more of a subscription, right? So even if people aren't using it, they might stay subscribed to it, so that the melt in the business model might be much slower than other ones, right? So this is kind of what's going on with Duolingo. The other one issue you have with Duolingo is, let me show you guys something very important here with Duo. And this is even despite the stock crashing. And remember, I used to have a put position on Duolingo. I did phenomenal in it. I think I made like 50+% in a quick amount of time. It was amazing, right? Duolingo's PE's come down so much. Like last time I looked at Duolingo, like back when I was buying puts on the stock, the PEs were like really, really elevated. And I guess they're not anymore in regards to Duolingo. So I guess I can't even say that anymore, right? So, I mean, with Duolingo, the thing is, I wouldn't trust betting against a stock in 2026 or beyond. I just wouldn't, right? Also, it's not a stock I really want to bet on either, but I think the big money betting on the downside, I think it was to be made this year in 2025. So if you bet against Duolingo this year, you should have made crazy money on that. Good for you. I don't think there's easy big money to be made on Duolingo in 2026 betting against it, right? So I just wouldn't feel comfortable betting against Duolingo in 2026. I just wouldn't. It's not, 2025 was the year you could have made bank. 2026, you're pressing your luck, in my opinion. Now the Robinhood, so phenomenal. The Robinhood turnaround's historic. Like, it's unbelievable the way this company's turned around their income statement in the past 3 years. It was dumpster fire trash, like F-grade level income statements like 3 years ago or so. It is not like that anymore. It's A+. And look at total net revenues, up, basically doubled up year over year. Incredible. Total operating expenses was up 31%, but that's nothing compared to how much their revenues are up. Net income was up 271% to 556 mil. Diluted EPS 61 cents. Okay, so what's the issue with the Hood? Okay, the Hood, in my opinion, has two issues. One, the PEs. I don't care if you're looking at a trailing 12-month PE, forward PE, 2-year forward PE, they're very high, right? The other big issue the Hood has here, and why I'm not buying it despite it having an amazing income statement and balance sheet, the reason I wouldn't step in Hood right now is you got to understand we've been in a 3-year massive epic bull market. Massive epic bull market for stocks and for Ethereum and for Bitcoin, okay? All three. Guess how Robinhood makes its money, okay? I don't think it's rocket science to, know how they make their money. Look at where their big money comes from, right? Net interest revenues certainly is a big number for them, but transaction-based revenues is the big one, right? Transaction-based revenues, $730 mil from 129, up 129% year over year. The business has been on fire. The issue is, at some point in time, this bull market will come to an end, right? I don't know when it is. It could be next year, it could be the year after, it could be the year after, it could be the year after. At some point, it's gonna come to an end, right? Robinhood's revenues in that environment are going to go down substantially, right? So then you're going to have a whole re-rating of the stock, and you're going to have a nasty crash. Because here's the deal. Robinhood trades right now at very high P ratios. So once the revenue growth all of a sudden starts to collapse, right, the stock price is going to collapse twice as hard, essentially. And that'll not be a good thing, obviously, for Robinhood stock price. And so I wouldn't feel comfortable stepping on Hood here. You usually want to step in on Hood when you've gone through a big bear market. Because when you've gone through a big bear market, no one wants to own some company that makes a bunch of money off of Bitcoin, Ethereum trading, and stock trading, right? And options and all that sort of stuff, and margin. To buy now, where margin levels are pretty much at record highs, right? The stock market is right around a record high. Bitcoin's still quite a ways off of record high, but it just set record highs, a month ago or a few months ago? Ethereum, same exact thing. I think Ethereum set a new record high within the past month or so. So, the growth rates in 26 are going to get harder to push up. Like, they could still come in with nice revenue growth based upon anybody's standards, but it's not going to be like up 129% year over year type numbers, right? Doubling up the revenues. And so you'll have a slowing of the revenue growth rate in 26. And then if we ever got into like a bear market in 27 or something like that, then you could really talk about major problems for the revenues. And then you'd have a massive collapse in the stock. And when we're talking about a stock like Hood, just understand that stock could go down 50 to 80% in 12 months. It's not like, it's just, it just goes down 10, 15%. It'll go down 50 to 80%, right? And so I'm just not willing to step in at this stage of the market. If we were in a different market, I would be like, dang, the company has its stuff together. How Hood handles the next bear market is going to be very important for the long-term trajectory of Hood stock. If we're talking about Hood eventually becoming a $300, $500 type stock, how they handle the next bear market is going to be really important whenever that next bear market is. If they handle that well, they're able to keep the business model very profitable and have revenues maybe go down a little bit, but not like plummet. Then we're talking about Hood in the next bull cycle could be a $300, $400, or $500 stock. Okay, so that's what's going on there. Hood's a very impressive company, man. The historic turnaround in regards to that. And it is a stock I'd be willing to own nowadays. I just don't want to buy it right now. But could I own Hood someday? Oh, I could absolutely own Hood someday, maybe. Tom Lee, next one up here.
It's good to have you. Welcome back.
Yeah, thanks, Scott. Good to see you.
So the market obviously assumes that this is all going to happen. The government's going to reopen, and we're just going to get back on our merry way in the stock market. That's certainly what the trade says today. Am I right?
Yeah, I think there's a certain measure of relief because the shutdown robbed us of visibility on the macro data. And of course, there's economic hit and they're suffering because, air traffic is slowing. So I think for many reasons, I think this shutdown was a problem for investors.
So what about now between, now and the end of the year? It's the AI trade that really seems to be debated. How do you feel about it heading into this final stretch?
I think it's still in really good shape fundamentally. We know there's a lot of visibility for AI spending, and we know there's still innovation and gain of function taking place with the models. So to me, it makes sense that there's still a payoff coming. I think one of the issues that investors are going to grapple with is even though they may say AI stocks are expensive, NVIDIA still only trades at 29 times forward earnings. I mean, it's still cheaper than Costco, so it's hardly a bubble valuation.
No, but I don't think when they talk about the valuation of AI stocks, they're necessarily talking about NVIDIA. I think you would agree with me on that. They're more so talking about names like Palantir and some others where you could easily say, yes, their earnings have been great and the story is incredible, but at some point you're only willing to pay X for a stock, and maybe that one's gotten a little bit too rich, using that as an example of the kind of names they're talking about.
Yeah, I mean, I think Palantir is an example of what they call like an N=1 company. You've got a founder-led business developing products that really seem like magic for the companies that adopt it. So, should this just be getting a softer multiple? I don't think so. And Palantir's opening up so many markets. And if it was a venture capital firm, they'd be getting, potential carry for how they transform businesses. So to me, I think that this is still a market discovering how to define the valuation model for Palantir. But to me, that doesn't mean it's a bubble. People would have said that about Tesla in 2018, because it looked incredibly expensive in the stock, and Tesla has been a huge performer since then.
But what was last week about then, do you think, at its heart?
Well, I think at the heart is the market wobbles, and so when the market wobbles, people, two things, one is they start to take shots at the leaders, right? Because they try to take down the leaders, thinking that's what leads us down. But the second, it really highlights the grim reality that we're about to have a third year of double-digit gains. The S&P's up 80% over the past 3 years, and funds are measured on 3-year performance. Only 21% of fund managers are beating 80% over that 3-year period. It is one of the worst ever periods for fund managers. And so they'd rather see the market fall so that it falls to their performance level. I think what's more likely, of course, is the market follows a seasonal pattern, which means there's going to be a lot of chasing into year end.
Don't you have any concern at all about the level of money that these companies are spending on their build out, and now the new wrinkle of tapping the debt market rather substantially to help do it?
I mean, Scott, yes and no. I mean, AI is proving to be a scale game. It's not like you and I could start a garage and make a model competitive with OpenAI. We need to have scale and a lot of chips. That's really the model that was required for telecom infrastructure and for energy infrastructure and, of course, for internet infrastructure and even fiber. So it makes sense that a handful of players are really playing a big role. And just like in the energy system, there's 8 majors. Everybody spends money on the 8 majors, and the 8 majors pay a smaller ecosystem. So
I disagree with Tom Lee. Disagree with him quite substantially here, okay? So the way he kind of frames AI is, the ones that spend the most and buy the most chips are going to be the ones that win, okay? Listen.
Jermaine struggled for years with dental issues before finally finding Nuvia. Listen to what he wanted most after his smile makeover.
That's not how this works. That is not how this works. It's never been how this works, and this will continue. Look at a company like Palantir. Palantir, you can make a strong argument, is winning the most at AI, right? At least in the software space, if we want to put them in that space, okay? They've been loading up on NVIDIA chips. They bought, $100 billion of NVIDIA chips, and that's how they all of a sudden have a successful product. No. And so, by just spending the most, people think like that company's going to win. No, and it doesn't matter what technology we've ever dealt with. Like, it's not how it works. The company with the best solution and it knows how to market it the best, they are the ones that win. Doesn't matter. Another company could spend $1 trillion on the technology. If some other company understands the best way to go about it and understands marketing better than the other company's going to win. One that spent a fraction of what the other company spent, essentially. And so that will be no different than how with this AI game, there's going to be some companies that spend fortunes and don't get much out of this. There's going to be other companies that spend very little on NVIDIA chips and AMD chips and things like that, and might end up actually being huge beneficiaries of AI and win massively. So it's just how it is, man. It's just how it is. I don't know what else to tell you. Okay, next one up here. Ed Jordani.
Thought about you a couple of times recently, Ed. Number one, I thought about you when we basically we're at 6,900 on the S&P, and I was thinking, wow, Jordani was 7,000, and actually, you think it could even go further than that, maybe by the end of the year. And then I thought about Tom Lee, who said he had similar targets, but said near term, definitely going to be bumpy because of the AI trade, and people were definitely worried about AI. Is that finished, or is there more to come in terms of just that particular sector?
Yeah. Tom and I have basically been looking at the market the same way. And a week ago, when I saw that the bull-bear ratio that Investors Intelligence puts out was over 4, I concluded there are too many bulls. And it looks like we cleaned out some of the bulls last week. But yeah, I think this is kind of a buy in the dip market, particularly in AI. I know there's a lot of nervousness about AI, but that's a good thing. In the late 1990s, when I was around during the bubble, the tech bubble followed by the tech wreck, nobody saw the tech wreck really coming. Nobody was really worried about a bubble in the market that I can recall. Not the way it is today, where everybody seems to be worrying about it. But I think AI is all right. I think it's basically an app that has widespread applications. And what the payoff is actually in the cloud. The cloud providers are making a fortune as a result of AI.
I was thinking that too, that I'm always trying to figure out what the hardest thing to embrace is, because that's always the right thing. You know, when a stock, you feel like you're ready to get sick to your stomach, that's probably when you should buy instead of selling it. It's almost always like that. So my idea is maybe we still don't understand how transformational AI could be down the road, and we could still be but we won't know for quite a while. What fascinated me about your comments, Ed, was how strong earnings have been. In fact, you could say that there's a floor underneath this market, not based on multiples expanding, which could happen because of the Fed, but based on the E side of things, much better than people thought.
Yeah, well, I am an economist, but somewhere along the way, I also became a strategist. And I always found economics a little bit difficult because there's so many variables you have to forecast. When it comes to strategy, as you said, it's really PE times E. It should be that simple. And it's very simple to forecast using that model. Getting it right is where the trick is. But on the E side, it's been phenomenal. I mean, you would think that with all the commotion coming out of Washington, the geopolitical commotion, the pressure on margins from tariffs, that this would be a bad year for profits. Actually, it's phenomenal. We're going to have record highs in S&P 500 once again for the third quarter in a row. And the analysts' expectations just keep getting beat dramatically. So, for example, in the current quarter, the current earnings season, analysts expected an increase of about 6.5%. It's coming out 14% on a year-over-year basis. So you're absolutely correct. I think that the earnings are there to keep the market going. And in a sense, we've had an earnings-led melt-up, which is, of course, the kind of melt-up that you really want.
Yeah. It'd be nice if things were based on like multiple expansions. But what do you have the forward S&P multiple at right now, approximately?
Well, right now, the actual forward PE is running around 22 to 23. It's been there on and off. I mean, when we came out of the pandemic lockdown and the Fed came in with its monetary easing to help us get through it all, we saw that the PE zoomed up to
Listen, it is what it is, and this is so bullish for Bitcoin. They're going to have to print so much money. They're going to have to. Bitcoin is really priced with how much fiat currency is sloshing around in the world. And in order for all of this to play out and work, we have to debase our currency. We have to devalue our debt. And we have to create more fiat. It's going to send Bitcoin nuclear.
22. And so it took about 6 months to get there. And here we are back at 22. I know a lot of people are uncomfortable with that, but, a lot of that obviously is the Magnificent Seven. They're selling at 30 times forward PE. The S&P 493 is selling at about 1920. That's not cheap, but it's not crazy.
Yeah. So you said.
Okay, let's finish this off with them.
1,000 by the end of the year. If you change that you should have stuck to all. Yeah.
No, the basic bottom line of it all is we're in a bull market. It's been a volatile year this year, but at the end of the day, we're at all-time record highs in the market in the past couple of weeks. And I think there could be a good solid Santa Claus rally. I tend to focus on November and December rather than on the Thanksgiving to Christmas period. And that usually adds about 4 percentage points.
Okay, so let's talk for a moment about Mag 7, because those are the ones that are most impactful to the market by far. Let's talk about them. You know what? Let's go down the list. We can broaden it out even a little bit. We can say big tech in general. So I have a big tech watch list here. So how are we feeling about these big tech earnings for next year? Apple should have very nice earnings growth next year, no doubt in my mind, based upon this iPhone cycle. Adobe, as stable can be. They should have very nice earnings growth next year. Oracle should as well. They're spending a fortune on CapEx, but as far as their earnings, they should strengthen quite substantially next year. Intuit, yes, consistent company, kind of like an Adobe. CRM, yep, huge increase in profitability. IBM, probably. I don't track them on a high level, but I would say probably earnings will be up very nicely for them next year. Netflix, yes. Meta, yes, but how crazy does Zuckerberg take the spending in 26? If he doesn't go that crazy with it, then EPS will skyrocket for the company. If he goes aggressive, then EPS won't grow nearly as fast as it should. We'll see, but should grow earnings very nice next year. Amazon, yeah, earnings should skyrocket next year. Microsoft should be a big up year. Palo Alto Networks, likely yes. Snowflake is a whole situation. We don't have to talk about that one. Uber profitability should continue to skyrocket next year. Vago, yes, should continue to skyrocket next year. Tesla's a complete wild card. Probably, I don't know if they're going to be down again earnings next year, but it's not looking great for them. Google McDougal, earnings up substantially. Shopify, earnings should be up substantially. AMD should be a rocket ship ride in regards to their earnings next year. NVIDIA should be up as well, nicely up. Not nearly as extreme as the past few years, but they should still have nice earnings growth next year. MU should be a rocket ship ride. And then Palantir, rocket ship ride. So the earnings story is there for next year. When it comes to big tech, which those are the stocks that matter the most to the market. They just do, man. The other stocks, like, what Elf does, what Celsius does, what Nike does, those sorts of stocks, like what Whirlpool does, whoever, those stocks just don't matter to the market. They just don't. Those big techs do matter. Their market caps are massive, and they're what a lot of people are invested heavily in, especially if they own index funds, which is what many people do. Okay, Stephanie Link.
The Senate's getting closer to a deal to end the government shutdown. Still has to pass the House. So there's a few more hurdles. It's going to take a few more days. Does that erase some of the other concerns like inflation and, of course, valuations? Is this good enough to kind of take the bull market and put it back on track, the idea that we might have a deal here?
I think it does. The word of the day is seasonality, and that's because...
She's already got her Christmas tree up. What about you guys? You already got your Christmas trees up? Come on, man. They're getting them up early.
The fourth quarter, on average, cumulatively, over the past 50 years is up 8.5%. So I think you use the volatility that we've seen so far in November, which, by the way, we were supposed to get volatility in September and October. We never got it. Markets actually did much better. So you use the volatility that we've seen so far to be adding into this seasonal strength. You add to financials, you add to energy, you add to industrials, technology, discretionary. And that is mainly because the economy is still on very sound footing, and earnings growth, Frank, running up 12.5%, and revenues up about 8%, margins better than expected. So I think you buy any pullbacks, where especially if numbers are going higher, to those stocks that have kind of pulled back with the overall broader market.
All right. To your point, the economy is very strong. If you look at any estimate for the for GDP for this quarter, it continues to be strong. I believe Atlanta Fed actually increased it by like a basis point last week as well. But I want to talk to you about something that Bespoke put out. Now, this is pretty interesting. You look at the S&P 1500, which I know you're familiar with, mid caps and small caps in there. Communication services and tech, they're both in bear market territory, more than 20% from their 52-week highs. Is that concerning as you look deeper down the cap that we're seeing these kind of pullbacks in so many names?
I'm actually pretty encouraged that we're seeing this broadening out that we've all been talking about. It's actually been fits and starts in terms of the broadening out. And so I think you want to own tech. I think you also, though, want to own all the other sectors that I mentioned that should outperform into the end of the year. You can add mid caps and small caps if you like. I don't. I actually would rather own more cyclical companies on the large caps side. Both have the same kind of factors in terms of how they trade. So I'm encouraged. I think it's going to last into the end of the year for sure. $7 trillion of cash on the sidelines, Frank. I don't think it's all coming into the market, but it certainly is a nice tailwind.
All right, that's a fair point. We have a lot of earnings this week, including big tech earnings. CoreWeave, Cisco, Applied Materials, Sony, SoftBank. Any of these have the potential, upside or downside, to have a market impact like we saw with Palantir?
Yeah, smalls and mids, that might be more of a story for 26 and beyond, because a lot of those stocks are still down big. And so those could be, tax loss harvest type stocks. Those are something to keep in mind. I appreciate y'all for joining me as always. Thank you so much for being here. If you look at Applied Drone Prep Stock Group.
Okay, I think I agree with Jeremy. I think I'm out of here as well. If you enjoyed this video, I know it's kind of a combination of stock research and how to analyze new stocks that you've never heard of, as well as reacting to this video here from Jeremy. We can probably watch this. I think that is it for the rest of the night, unless there is something interesting. I'm just going to be over here researching. There isn't anything too interesting to see here. Women panics after a mandatory DNA test. U.S. government admits chemtrails are real. I have no idea what that is. All right, I think that's definitely it for me. Thank you so much for joining me. Make sure you subscribe. I'll talk to you tomorrow. Have a great night. Peace.